Welcome to today's webinar, How to Navigate Today's HOA Insurance Challenges with Confidence. And I'm Chip Stewart, your moderator for today, and also the Real Estate Practice Leader for Hub International nationally. During our session today, we'll discuss some common issues aimed at board members. What do board members need to know? Mistakes that are made by boards, and understand key coverages and responsibility. And we'll have some discussions on practical strategies to help board members navigate through today's conditions with a lot of confidence. Before I introduce all our speakers today, let's just take a look at some of the housekeeping items so that you know you can participate in today's webinar. We will be recording the webinar, and we'll send out a recording to all the participants later, so you can watch it over and over and over. You can submit questions during today's webinar during the comments questions box. You just type in your questions. We'll be reviewing them as much as we can. I'll be reading them back to our panelists and trying to get to as many as I can. And after the webinar, you'll see a survey pop up before you exit. Please take a few seconds just to fill it out. We greatly appreciate any feedback, especially the positive comments. Now I have the pleasure of introducing today's speakers. We're excited to have all these panelists with us. The first one is Greg Floyd. He's a senior VP at Hub International, and Greg is a very experienced commercial lines insurance broker, but most importantly, he heads up our HOA practice, condominium practice for North America, and our real estate practice. And he has got about 1,000 community associations that he represents, so we're going to be very interested to hear what he says. And he's got about 16 people that are committed to the HOA practice. Jonathan Lum is a board member at West Lux Fairways. Jonathan is the vice president of the HOA board, and he is the treasurer for, I'm going to try to get this right, Mauna Lua Village. Did I get that right? I hope I did, Jonathan.
Mauna Lua Village. Pretty close.
Beautiful.
Pretty close.
Thank you. Yes. He has been a realtor in the state of Hawaii for the last 34 years, so congratulations on that. Before that, he retired from the Naval Facilities Engineer Command of the Pacific for facilities support, contract manager, and facilities engineer. He led over about $4 billion in facilities reports and support contracts for the U.S. Navy, so thank you for your service. Zach is with us, Zach Page. He's a business association manager at CWD Group. Zach launched his career in the association management with CWD Group back in about 2011, and since then he's served as a portfolio manager for many of the company's premier clients, including large-scale homeowners, associations, and 500 homes with luxury high-rise towers in downtown Seattle, Bellevue, and he manages property ranging anywhere from 100 to 700 units. In addition to that, he is a member of CWD's group leadership team, where he's part of the quality control process for oversight and so forth. So his resume goes on and on and on. Welcome to the committee here, Zach. Ben Weiskowski is also with us. He's a vice president of Hub International. Been here for about 10 years and joined us in the commercial lines, property and casualty. He also has extended his relationships and manages our relationships with HOAs in Hawaii. Ben is an expert in property casualty and HOAs. So we want to welcome all four of our panelists today. And here we go. Let's start on the first slide here with Greg Floyd.
All right. Thanks, Chip. Appreciate the introduction. I'm going to start off talking about the declaration, or the CC&Rs. And I start out here because the declaration is a very important document, the most important, in my opinion, for any condominium association. So what this document is it's a formation doc that is attached to every single community association. It governs all aspects of life and how a condominium can operate. And within the declaration, there is always going to be a section dedicated to insurance. And so I like to say that insurance section of your declaration is every association's roadmap for how to procure an insurance product that is going to protect them adequately. Now, there's a lot of nuance in the declaration or governing documents in relation to insurance, But I'm highlighting just a few kind of key points here today that run pretty parallel across all states. Because as a caveat, every state has different condo statutes, and the declaration is a derivative of the statutes to some degree. So every declaration is also nuanced and different from the next. However, some provisions run pretty uniform. And so first, one thing you're going to always see in a declaration is a provision that says that the master policy, being the policy purchased by the association, is primary over insurance coverage that is purchased by unit owners. Now, realistically, where we see this come into play most commonly is when you have a loss that impacts a unit. And invariably, most every loss that happens in a condo association does impact units. They usually derive from units and impact other units. So where you have an issue with the insurance coverage in a post-loss situation is that the master policy may or may not respond for coverage to the units, and the unit owner may or may not purchase coverage for their unit as well. And if both do, if you have the association responding for damage in a unit and you have a unit owner purchasing insurance for their own unit, this provision says that the association's policy is primary and will respond first over a unit owner's. And this can run counter to what a lot of people believe in condominiums, at least from my real world experience, because a lot of folks, and maybe from a common sense standpoint, might say, oh, well, unit owner had a loss, maybe caused the loss, maybe they failed to install something correctly, and it's their property in the unit that's damaged, so it should be their insurance that responds. And the law and the declaration in most cases says otherwise, and it's the association's responsibility to respond first. Another provision commonly found in the declaration that governs all condominiums is that the association's insurance cannot subrogate against a unit owner's an insurance policy or a unit owner to recoup damages. And by definition, for anybody that doesn't know, the process of subrogation, by definition, is the insurance carrier for the master policy attempting to recoup damages or recoup their loss from what they feel is a responsible party. And the insurance carrier can subrogate, but not against unit owners. They can subrogate against third-party contractors or other entities if they feel that those parties caused the damage, but they cannot subrogate against their own unit owners. And the reason for this is pretty simple. The insurance purchased by the association is paid for by and procured for the benefit of unit owners. That's how condominium associations are funded. And so if that is the case, then it holds true that the association's policy should be able to be utilized for the benefit of the unit owners, and that then they cannot then go back and subrogate against those very unit owners. So the combination of these two provisions, and I kind of say that they work hand in hand, that the association's policy is primary in the event of duplicity with the unit owner, and two, that the association's policy cannot subrogate against unit owners. When you combine this, what it yields in the end is that the association's insurance does a lot of heavy lifting in post-claim scenarios. And of course, all of this is after the deductible is met. And we're going to talk later about deductible funding and who's responsible for the deductible. But once that deductible is met, the association's policy is really on the hook for quite a bit of the losses that occur in condos. And that does add to the challenges of insuring condominiums too, because loss frequency can be an issue in these types of buildings. Another key provision in accordance with the governing documents is that the association, or most policies, I should say, most actual insurance policies themselves defer back to the declaration to dictate how coverage is intended to respond for unit interiors. You'll notice when I was talking about the association being primary, I said the association's primary if there is duplicate coverage with a unit owner, but not all association insurance policies respond for unit interior coverage. So there's really three main ways a condominium can be insured. And this is really a key takeaway for anybody. The most basic way to insure a condominium is what we call bare walls. And this means that the association's policy covers the building and the shell and core and all of the common elements, but it does not cover the interiors of the unit. Of course, in that situation, there's no duplicity because the association's policy doesn't cover the unit interiors to begin with. And so some states have embraced a bare walls mentality and some have not. The second way to insure a condominium is called single entity, or sometimes known as original specs. And what this means is that the association, of course, does cover the shell and core and common elements and all of everything that bare walls covers, but also covers the unit interiors, but only as originally built by the declarant, and subsequently excludes all improvements and betterments and anything that was improved into the unit by unit owners after purchase. I find this way to be a bit challenging because as the buildings age and they sell to multiple unit owners over time, it becomes increasingly challenging to know what was original and what has been upgraded over time, especially if the current unit owner is not the owner who performed that upgrade. So that's the single entity way of doing it, which I think does have some challenges. The third way to insure a condominium, which I personally think is the best way, is called an all-in policy. And this is as it sounds. The association insures the building and all of the unit interiors as originally built by the declarant and including all subsequent owner upgrades, equipment, betterments, improvements, fixtures, basically everything in the unit that is attached is insured by the association. The layman's way I like to say for people to think about this is if you cut the roof off of your unit and you flipped it upside down, everything that sticks, the association insures. Everything that falls out is still the unit owner's responsibility to insure, because in no scenarios does the master policy ever cover personal contents of a unit owner, like furniture and electronics and personal belongings.
So Greg, that makes it pretty easy for us to understand. Is if you turn the building upside down, okay, if it holds, that's part of that. Talk a little bit just before you go on about the CC&Rs. Where do you find that wording? Is that is it in the HOA documents? Is it something we need to have in the insurance policies?
Yeah, so it's in a couple different places actually, Chip. It is in the governing documents of the association. There's usually within the insurance section, there's another little subsection called special provisions or conditions, and the fact that the association's policy is primary over a unit owner's and the waiver of subrogation language is usually found there. And then the insurance carriers on their policies, they have adapted that language as part of their standard condo forms, as we call them. So there's standardized industry condo association policy forms that need to be put on condo insurance policies, and that is because they capture some of these provisions, like the waiver of subrogation and that their policy is primary and so on and so forth.
Okay, good.
So Greg, one quick additional thing I'll note is loss of use is typically not covered. A lot of condominium insurance policies will not cover loss of use. So if you have to rent an apartment or stay in a hotel room, it's good to make sure that you have loss of use covered as well for, could be up to 6 months or a year.
And Absolutely. Zach, that would come with your HOA, the homeowner's policy, right?
Correct.
Yeah. Yeah. The HO6 policy. And, I've looked at a lot of those HO6 policies and, just as a side note for any unit owners listening to the call here, that it's often that the loss of use comes with some abysmal limit of like $5,000 that could maybe get them an apartment for 1 month. So get a lot of loss of use coverage, because we've been through a lot of claims and some of them take longer than a month to fix. So that's a good takeaway as well. All of these provisions I was talking about here, association's primary, all-in coverage, all of it is, of course, once the association's deductible is met. And so what I want to jump to next is to talk a little bit about how to fund for the deductible, because make no bones about it, we are in an environment of rising deductibles right The insurance market, not just for condos and HOAs, but for property and for really all lines of coverage, has been hardening for the last 5 years. And Ben's going to talk a little bit more about the market conditions in a bit. But in part of a hardening market is changes or potential changes in deductible structure. And we've seen deductibles rise. I remember 5 years ago, probably your average deductible was $10,000 in a standard size condo association, maybe 25. And now I would say 50 to 100 is pretty common. And per unit deductibles have also started to come into play. So,
and do you see that changing in 2025, 26?
Like going back down?
Yeah.
I don't. I think it's the new normal. I mean, I think that as we come into maybe the stabilization of the market, we might start to see the ramping up slowing, but I don't necessarily see them going back down. I think
so these deductibles are very meaningful if I'm a board member, because now I got to figure out how to allocate it.
Well, exactly. And that's my key point here with talking about deductible responsibility is if you're governing documents, and again, I'm likening back to the governing documents, the declaration, because it's such an important tool. If your governing documents are silent on how to handle the deductible, then really it's a common expense. And I will tell you from being in the condo business, every condominium is going to have losses. I mean, the bigger ones have multiple losses every single year. And maybe some of those losses are small and they're under the deductible, but that is still money if it's a common expense that's coming out of the association's operating income. And these are nonprofits that do not have a lot of expendable operating income to fund all of this unforeseen expense. So one of the things that you can do as a solution for the rising deductibles and to control unforeseen expense is to put a provision in your governing documents to make the unit owners, the affected parties in some capacity, responsible to pay for the association's deductible, which in turn is then insurable as part of their HO6 policy. So the core purpose of it is to make insurance companies pay for all of it and not have unforeseen operating expense. There are a few different ways to do this.
Talk a little bit about this. You said $50,000 or $100,000, but there's also HOAs that are, in wildfire, earthquakes, windstorms, and those deductibles tend to be a percentage and can be a lot more than $50,000.
Right. And that is actually a very key distinction. So when I'm talking about deductible shifting responsibility, I'm talking about mostly domestic caused losses, not catastrophic perils. Catastrophic perils like earthquake, wildfire, hurricanes, those deductibles are pretty much always going to be a common expense because the affected parties weren't really involved in the loss. It's just it's a natural catastrophe. So we actually, when we do this type of language in the declaration to carve this out, we make a special note that it's not meant to apply to catastrophic perils. That has to be a common expense. 3% of a $100 million building is too big for any one unit owner to shoulder.
Right. Exactly.
Yes. Yep. So, and specific to like domestic water losses and fire losses, not necessarily wildfire, but fires that start in the building. Those deductibles, we're seeing a lot of 25, 50, hundreds right now. So you can fund those through the unit owners if you have the proper provisions in your governing documents. And there's a few ways to do it. You can make the source of the loss responsible, which is basically saying if the unit owner was negligent or failed to maintain something, or maybe even something just failed that was in their unit and they didn't do anything to cause it, but it was their maintenance responsibility of that item. You can make the source unit owner responsible to pay for the entire deductible, and then they in turn can go and turn it into their insurance carrier.
Well, if you're the top unit and you cause water damage, you're not happy in this scenario.
Yep. In that scenario, top units are going to be impacted more by deductible obligation, but I can tell you the bottom units feel more victimized by the loss. So, it's a trade-off.
Yeah.
Obviously, if the single unit is impacted, then that unit's responsible for the deductible. Another way to do it, and this is the way that is kind of the yang to the yin of the source unit responsibility. The second way to do it is you can say the affected parties are responsible for the deductible on a pro rata basis of how much damage each one of the affected parties sustained. So that's increasing in popularity because of rising deductibles and an appetite to not put the entire amount onto a source. So now we're starting to share the load and maybe make it more affected party responsibility. Or you can make it a combination of these things. Again, this is done through a declaration amendment if you don't have the language in your governing documents already. And so your broker and your attorney can work together to tailor the language however you see fit.
But the insurance needs to match what you've decided on. So out of these four options here, you need to make sure that you have the right insurance.
Of course, yes, absolutely, always. Now, I would say that the insurance carriers, they don't tend to get too involved in how the deductible is funded because it's a deductible and they don't necessarily really care. But the HO6 policies for the unit owners have to match because, again, the goal is that we are transferring this to a unit owner for the end purpose of their insurance paying for it.
So if I took these four, and so let's just say I'm the source unit responsibility and it's a $50,000 deductible, what am I doing? Am I just paying that out of pocket? Is that a loss assessment that I could put on my HO6? How do I handle that if I'm a source unit responsibility party?
That's a great question. So if you're source unit and we're doing source unit responsibility, then it gets tendered on the HO6 unit owner's policy, and it can be loss assessment that covers it. It can sometimes be your liability coverage that covers it because you're technically causing property damage to other units. So there's a few different triggers in the HO6 policy depending on the carrier. So I always say talk to your personal agent about what trigger is going to be, but it's usually loss assessment or liability.
Zach, do you have any examples that you've seen in your management experience on these types of scenarios?
I was going to bring a couple of those up because negligence often gets thrown around as, so-and-so flooded their unit up above and now it's negligence. They didn't fix something. That's not typically the case. A good example would be, a bathtub drain that starts leaking over time. That's something their maintenance responsibility is for, but it's not negligence. They didn't know about it. They didn't intentionally not fix it. What could be considered negligence and where a unit might become the source unit responsibility is you come home late at night after Taco Tuesday and one too many margaritas and you overflow your bathtub. That could be potentially negligence, even if it is an accident. Installing a bidet without a plumber or doing it incorrectly.
So you've seen all that, huh?
I have seen all of this. Yes.
So,
Yep,
Greg or Zach, how does negligence play into this? What you keep saying negligence? I mean, yeah, the bathtub scenario is definitely negligent. Does that hurt or help my insurance?
It typically. Go ahead, Zach.
I was going to say in the language that we put in the declarations to transfer this, negligence is not the only trigger. It's really failure to maintain any item for which you have a maintenance obligation. So negligence is a hard bar to hit, and so it's not intended to be just in the event of negligence. It also is extended to basically failure of any item in your unit.
Yeah. What I'm seeing a lot is the affected unit responsibility these days. So in the bathtub drain situation, it leaks down below. Those units that are affected and the source unit are responsible for a percentage of up to the deductible and expenses. That's pretty common.
So you're both seeing mostly number 3 here, affected unit responsibility seems to be the most common deductible responsibility that's out there right now.
Correct. Yep. Yes. To pass it among different insurance carriers.
Yeah. And what's interesting is that's not what I would have answered 5 years ago. I would have said it was source unit was more common, and there's been an industry shift because of rising deductibles.
Yeah, because if I'm an affected unit, I want the source unit. I want them to pay. I don't want to be because it wasn't my bathtub.
Yeah, it's condo HOA living. Can't make everybody happy.
Yeah. All right. Shall we move on to the next slide?
Yeah. Common mistakes boards make when buying insurance. There's a few things that I see as a broker specializing in condos that I see every week or every day. This is a collection of some of those items, and underestimating replacement costs is a major thing that we run into. I would venture a guess that 80 to 90% of buildings out there, not even just condos, just all property, all buildings in existence are probably underinsured right now. In light of and short of a third-party replacement cost appraisal, most buildings are underestimating their values just by submitting an average dollar per square foot.
So if I'm on an HOA board right now and I see that we're insured for, add the square footage up. Okay, I know what my square footage is, and if I see that we're insured less than $200 a square foot, should I be scared?
Yes.
And should Absolutely. I be asking what my D&O limit is?
Well, unfortunately, Chip, I have to say that D&O has an exclusion in it for failure to purchase adequate insurance. So your D&O is not going to save you if you failed to purchase adequate insurance. And in condominiums, and again, I'm going back to the governing documents because it's such an important tool, governing documents will require that associations purchase insurance at 100% to value. Some might say 90, some might say 80, but there is a responsibility to insure at a certain percentage to value, and most say 100% to value. And so the board of directors, for failure to purchase correct limits in a total loss scenario, could result in litigation against the board, and there would be an exclusion in the D&O for failure to purchase. So this is a really important thing. And my solution, just my quick thing, just one bit of advice for everybody to do is just inch it up year after year. You go 4 or 5% up every single year, regardless of what the market's doing, because that's basically the 100-year inflation index has shown to be roughly about 4 or 5% inflation every year. And that's going to keep you relatively safe. And then every once in a while, you can do a third-party appraisal.
But you said earlier, this is the most common. And if I'm a HOA board member, I get no credit after the claim for having low premiums. So you want to have this up as high. And it's the most common mistake that we see in real estate is having undervalued property, because that's what the insurance company is going to pay you at. And if it's not enough, now you have a whole new discussion.
Absolutely. Yep. So focusing on premiums is also another issue and ignoring other terms and conditions of the policies or deductibles, especially in a condominium where you have a propensity for a lot of water claims frequency, those deductibles can be huge financial burdens, especially if you don't have the deductible shifting language like I had previously just talked about. So, there's the old adage, you get what you pay for. To me, if you're looking, make sure you weigh and evaluate the cost metrics correctly, because there are scenarios where, yes, I would take a higher deductible to save a load of premium because it just makes sense. But if you're going to take your deductible from 25 grand to 100 and save $5,000 in premium just to hit budget, that might not be the best course of action.
Are you seeing big deductibles yield? So let's say I go with a $250,000 deductible. Are you seeing the premium relief for that? Or does it get to the point where the deductible, say at $100,000, that's about as good a break on the premium as you're going to get, and just going to $250 doesn't matter anymore?
I think that on almost all of the price breaks for deductibles that I see, I think it's a better deal for insurance carriers than it is for the insureds. I tend to see it. Maybe the $5,000 example is extreme, but I definitely have seen where you're going from 25 grand to 100 and you're saving $10,000. Well, that's basically a 1 in 7 year return on your money, and you're going to have more losses than 1 every 7 years. So you got to evaluate that correctly. I don't tend to think voluntary higher deductibles are cost effective for associations.
So why would you not want multiple brokers getting you multiple quotes?
Yeah, great question. Not to say that I wouldn't advise interviewing multiple brokers. owners. I actually encourage that process in an RFP or a broker interview type of scenario. You want to make sure you're well represented by choosing the correct brokerage representation, but then only have one broker go out to the market for you and solicit quotes from carriers. And the reason why is because the insurance industry is pretty heavily governed, and an insurance carrier will only accept a submission from the first broker that contacts them, not the best broker, not the biggest, not the one that's creating the best submission, or has the most clout or volume with that carrier, all these other factors that impact the relationship that exists between a broker and carrier. But they will just accept a submission from the first one. And so you could, if you have multiple brokers running to the market to get submissions, all that's going to happen is they're going to block each other to key markets. And then you might not even be able to get a complete product or have it negotiated correctly by having these multiple brokers involved. So interview your brokers and make your
Greg, let's just say I do go to brokers. All right, now I'm getting two different opinions on stuff. Who's going to compare the differences between broker A and broker B's proposals? Who does that?
The insured.
Yeah.
And unless you have a risk manager or somebody who's an expert in that, it's going to be really hard to make heads or tails of it.
So now the comparison's really on the board's shoulders, right?
Exactly. Yeah.
Okay.
Which is another process that usually, it can get fraught with problems because there's a lot of terms and conditions that are nuanced. And so unless you're an insurance professional, it's very hard to compare those. Yep. Another issue I see is inadequate communication with unit owners after binding a policy. So I'll just talk about this one briefly. The insurance is procured by the board of directors and not the ownership in whole. And any board members on the call are going to know that at best we get probably 5 to 10% of participation from owners in board meetings. So a decision to purchase insurance is going to be made, and not everyone in the building is going to know what that decision was. And so especially in scenarios where there's key coverage changes, higher deductibles, and if the unit owner is responsible for the deductible, even more so, you need to message that downstream to all the unit owners by providing them a document or something that your broker can help draft to get the message out to them so that they know what HO6 coverage they need to procure. I definitely have run into that scenario a lot. Believing a unit owner caused the loss and then is therefore the sole responsible party for that loss. This goes back to my very first thing where I said association's policy is primary over a unit owner's, and the association cannot subrogate against a unit owner. So in the event of an all-in policy, association covers the units and cannot subrogate back against unit owners. So even if this unit owner caused the loss, you cannot make them responsible. And I have cleaned up so many claims over the years where a unit owner was made responsible incorrectly, and then 3 months later down the road, somebody figured out that no, it's actually supposed to be the association that pays. So if you have questions about it, just ask your broker and they can help steer you in the right direction in that sense. And then, of course, and Chip, you mentioned this earlier about the catastrophic deductible perils being percentage-based, earthquake or flood or wind, wildfire. Some of those are 2, 3, 5% of total insured value. Those deductibles, unlike the domestic water and fire loss deductibles that can be shifted to unit owners, those deductibles are a common expense. They're insured then as they're funded, by assessment to all owners equally and can be insured on the unit owner's loss assessment coverage form. So make sure every unit owner knows what their obligation is, their individual obligation for the percentage-based deductibles for any cat perils in your region.
So what we're trying to do here is just, Greg, we're trying to get you to show us, some of the common mistakes that you've seen with HOA boards in the past. We're not saying that these are, everybody's going to make these, but they're just ones that little pitfalls that we just don't want people to fall into. And there's probably more, but we really only have time for the 6 of these today here. But you can talk to your broker and they'll tell you probably a few more as well too.
Absolutely.
All right, let's move on to the next slide, and we're going to talk a little bit about the experience And Zach, you're a little bit different than Greg, is that you're also on the HOA side. Greg handles the insurance, but you've got the overall responsibility for the relationship with the board and the building and the insurance, everything.
Yeah, definitely. Greg touched on a lot of key points, and a lot of those common mistakes are ones that I have seen in my own experience as a manager. In fact, one that I thought of was going out to different brokers. I thought when I started in the industry, you could do that, and I quickly learned that's not the case. The first broker to the table with the insurance carriers is the first one to get the business typically. And if you're trying to switch brokers by the time you have your first proposal, chances are you're already too late by the time you need to get a renewal. So that's something to work with your manager on and make sure that you are ahead of the game. If you want to change brokers for whatever reason, make sure you're talking to your manager well in advance of your renewal period. So 60 to 90 days in advance, you can review brokers and what their fees are, what services they provide. A lot of people forget about the extra services that most brokers provide. Like information, going to annual meetings, educating your board, educating your homeowners. Those are all really important things that go on top of what a broker is going to provide you in terms of shopping the carrier. So making sure you're well in advance of
I liked what you said earlier off this webinar, but you said, really talk. The HOA has to speak with one voice. You can't have 6 board members calling an insurance broker or an insurance company or adjuster or anything like that. And you, as the property manager, are probably the most qualified to speak for the HOA. But once in a while, you got somebody that's pretty good on the HOA that really does want to be part of it. But isn't it important for the HOA to speak with one voice so that there's not conflicting statements coming out?
Absolutely. Yep. You touch on a great point, Chip. And you usually you'll have boards of 3 or 5, and it's important for that board group to, well, they can speak directly from their own experience. They should speak as one voice to the community. So when you're presenting to the community, having the broker there to speak on their behalf, or having a board member that's a liaison to speak directly to the community about that information, that's going to be key to making sure that everyone's on the same page.
And let's see if Jonathan agrees with us later on, but I'll ask the question again. You mentioned too that maybe the broker should be attending at least one board meeting a year?
Yeah, I would say annual meetings are the best time for that. You usually get the most owner participation. Everyone's going to be there for elections. They want to know what's going on in the community. A lot of owners don't attend board meetings. Usually we get 5 to 10% in my experience. So
That's
making sure that you're sending out a notice that says, hey, we're going to talk insurance, and it's really important that you're here to hear this information. That's the best key. So yeah, annual meetings, or if you have a renewal that is not around that time of year, schedule a special meeting, schedule a special board meeting or a town hall or an information session where you can have the broker show up and talk specifically about insurance.
You attend most of the meetings, or you attend just basically the annual?
I attend all of them typically. So I'm there at board meetings. So I know what's going on in the background as a manager.
Yeah.
And so it really helps me to help advise my board of, hey, we're coming up on our renewal period. Let's schedule a special meeting or an annual meeting or plan for this. So that way we can keep our ownership informed and keep the board on task. So if one piece of advice for board members is be in direct contact with your manager around that renewal time, and let them help you schedule meetings so you can get the information out to your owners effectively.
And how far advanced do you start when the insurance word comes up, everybody's favorite? How far do you get that started in advance? Do you go, a week before, a month, 2 months?
Yeah, if you're going a week before, you're probably well behind the curve at that point. Greg will probably tell you that, hey, this is you have a renewal in a week, and I need your signed documents by the end of the week. So your shopping opportunity is sort of up at that point. So usually 30 days is when we're going to get most renewals. I always try and push my brokers to get me their proposals 30 days in advance. And if there's like I said, a broker change or a request by a board to have a broker change, we're talking 60 to 90 days in advance. So make sure you're in contact with your manager because they're going to put that on their calendar and say, I need to reach out to the broker, or I need to start investigating new brokers if that's necessary.
Ben, I'm going to ask you later, why do these quotes come in at the last minute? So just be prepared for that.
Some other things that we're going to touch on is deductible strategies. So Greg mentioned how the deductibles are going up. Again, the key is making sure owners and the board understand deductible responsibilities. Who's going to be responsible in a significant loss, or more commonly a water leak if somebody installs their bidet incorrectly or without approval. So make sure that the governing documents are being reviewed. Make sure that you're going over it with your manager and your broker. And in a lot of cases, you might need to get attorney opinion on these. So the best time to do that is before a loss happens, and you have angry homeowners coming after you saying, "Why are you billing me $50,000?" Get an opinion beforehand. That way, you know how to handle deductible responsibilities each time that they come up, because losses will happen, and having that information ahead of time will help both you and your manager know how to effectively handle those and communicate those to the homeowners.
You mentioned
Again,
10% is a good budget number, but the last 5 years, 10% isn't going to do it. So there'd be a lot of angry board members if I only budgeted 10%. What have you been budgeting just 10%?
where appropriate, usually, again, this is a communication effort on behalf of the manager and the board, reaching out to your broker during your budget time when you're preparing the budget to get an anticipated increase. Your broker is going to have the loss runs for the prior year. If you've had 5 water losses, chances are your insurance is going to come back quite a bit higher than 10%.
So you're really saying shoot a little higher. It's better to be a little bit higher and then come in under. That's what you're saying.
Absolutely. Yep.
Yeah.
Shoot higher. And if you don't need it for the premium, you can tuck that away for future premium increases or other budget needs. It never hurts to be over budget. Budgeting is a plan. It's not set in stone.
So you mentioned there's some challenges managing the owner versus the association. Tell us about that.
Absolutely. Yeah. So, like Greg touched on, is a lot of it's not so prevalent now, but in the past, boards would think that homeowners are responsible. They need to kick it back to their insurance. So again, I'll just reiterate that the association is primary. Your insurance will have to handle the loss and the payments for that loss up to, after the deductible. So the association has a responsibility not only for the insurance part, but also for by your declaration to repair the units. A lot of times, insurance only cares about the insured for that unit. They don't care about the units that are below. So the association needs to have a plan in place to make sure that the units that are impacted and the common areas are repaired. So that's one of the biggest common mistakes I see, is trying to push it back on an HO6 carrier when the association is responsible for making those repairs, getting the unit back to how it was, and making sure that that happens in an efficient manner. The other one is not collecting information as far as betterments and improvements. If somebody goes out and buys an extremely expensive painting or puts in really expensive finishes, and the association doesn't have that information, they don't provide it to their broker, and they're uninsured or underinsured on the value, often the insurance company won't cover those. And so then there's a lot of money out there that the association might be responsible for. So collecting betterments and improvements information annually is a good safe bet to make sure that you're covering those.
So let us in on a secret. How does the association or the HOA board decide these things? Let's just use the deductible. How do they decide what deductible to buy? Because that's going to affect the premium. It's going to affect the way the insurance is placed. It's going to ensure that it's also going to affect how many insurance companies will quote on it based on what they do. How does that lift the curtain a little bit? What is your experience?
Yeah, so it's usually a couple of board meetings where the board will sit and discuss and go over the proposals that were provided. It's a risk versus reward scenario. So making sure that the deductibles are not too high where HO6 policies won't cover them. So right now I'm seeing $50,000 to $150,000 that are typically possible with HO6 carriers. So you really have to weigh the risk versus what you're going to get back. If you're a community that doesn't have a lot of losses, that's a discussion that the board will have, and making sure that their deductibles are in line with that. If they're not, then you go back to your broker and ask why not, and have them to see if they can sharpen their pencils a little bit. So it's a collaborative effort between the manager and the insurance broker and the board members themselves.
Okay. Jonathan, are you about ready?
Oh, there we go. Yeah, sure.
Well, welcome,
I'm here.
Jonathan. So let's go. Let's talk about the market over. Well, we're going to go to Ben first, and then we're going to end up with Jonathan at the end, who's our resident board member here on the panel. But Jonathan, I want to make sure that you know that I'm going to ask you to comment on some of the things here that Ben's going to be talking about in the market overview here, because
Yeah.
it has been a tough 5 years for a board member with insurance premiums going up, retentions going up. It seems like it's all bad news. Ben, what are we looking forward here?
Yeah, no, you already hit on it, Chip. I mean, really, the last 5 years has been incredibly hard, not just for HOAs, but property across the board. Large increases, interest rates going up. As you can see, replacement costs, where to find it, how to buy, where to buy, what limit, and budgeting for what if this whole building goes down or this HOA burns to the ground, what do you do? So the last 5 years has been rough, but what we're starting to enter is what we talked offline about was a stabilizing market. And so for HOAs, we are seeing some kind of light at the end of the tunnel in 2025 and moving forward with new carriers, insurance carriers wanting to come in and be competitive in certain markets throughout the United States. So we're
Well, let
seeing
me ask. Let me ask Jonathan. Has it been rough?
Yeah, actually, for board members, 2024 was really a shock. I mean, uh, a lot of premiums went up 300, 400%, and in 2023 we were told, oh, expect the market maybe 10% increase, so that's what we budgeted. And now, with the 300, 400% increase, we had to go back to the owners with a special assessment, 5,000, 6,000 per unit. So yeah, it was kind of a shock. We had to, relook at our budget, see what we could cut. Uh, but yeah, the change in the market was kind of a shock to, I think, most boards.
So Ben, we're looking at some things here: rates, replacement costs. How do these all play into the end result that Jonathan sees?
Yeah, so I mean, it's kind of a culmination of many things. This, incurred premiums going up year over year, stricter underwriting criterias. You also had catastrophic claims. When you have fires in California, or you have hurricanes in Florida. You have less carriers wanting to write business, and when you have less carriers wanting to write business, you then have a select few that will, but at their dollar amount. And you start to see from 2020 to 2024, you see these insane increases like Jonathan's alluding to, where less competition, the market hardens, and then you have less capacity to buy your insurance.
All right, well, let's go to the next slide and see if there's any good news.
Yeah, so really, kind of back to my last slide and the last points on the natural catastrophic claims. You can only equate for those so much. It's gonna, they happen when they happen and where they happen. That's not our decision. So we have to do everything we can in the interim to find a place and a right buy-in point for our HOAs. So as inflation is still kind of on the rise and economic disability a little bit, you just go, hey, like how are we gonna figure out where to buy and how to buy? And in the market in 2025 in HOAs, we're seeing a stabilized market, which is good because now we're having more competition coming in the door in certain markets that want to buy, up new business and create more competition and help reduce or at least level out those premiums moving forward.
So that sounds good. I want to look at all that, but let's just say I'm an HOA board and we've never had a claim. I've paid my premiums on time for 10 years, been with the same insurance company, and my rates, like Jonathan said, went up, double digit. That's because I'm part of this pool, or what is it?
No, not so much. It's insurance carriers trying to not lose money. So from the years prior, you're seeing this effect of claims have been paid out through certain markets, and insurance carriers who lose money, they have to recoup that somewhere else. And unfortunately, that is at the guise of other HOAs. So you start to get increases across the board, less limits, and you get higher deductibles. Some coverages all of a sudden from one year to the next aren't there. So it's having to navigate that.
And what role would you suggest the broker plays in this?
Being diligent, and not waiting to the last minute, like we spoke about earlier, and providing a renewal should never be a week before, ever. No board should get that news that late in the process. You should be getting your renewals from your broker from 60 to 30 days prior to your expiration date. So they need to do their due diligence of shopping the markets and picking a handful of carriers that will be able to deliver good news. Because if you have competition in the market, you're able to get better rates from like carrier that will want to earn your business.
Yeah. So sometimes the best quotes come in at the end, it seems like. But, I think what Zach was saying is that, Ben, you should come in, 30 days and at least tell them where you're at. And then if the board wants to wait for some of these slower markets to come back and quote, and sometimes they're holding their cards to the end, I know that. But at least, you've got a pretty good indication 30 days at least before, even if not every single market's responded, right?
Correct. And also, I do want to touch on that point about kind of the specialist role for picking your broker and doing the due diligence on as a board and to the owners is making sure not just picking a broker who has capacity in the marketplace, but has risk management, has claims advocacy, has all the tools and resources from a water mitigation plan to help your board get ahead of carrier's decision on your premiums, but helping them reduce those premiums on almost good behavior and good risk culture.
Yeah. I
I
want
would
to say
also
some.
add, Ben, real quick on the specialist thing that with specialist brokers, a lot of times there might be access to certain markets that are either proprietary or limited distribution models, meaning that there might be certain carriers that only distribute through specialist brokers because they're specialists in that field. So you might get a little broader carrier access through specialists as well, with the fear of sounding self-serving, but it happens to be true as well.
Yeah, that's a great point. That's a great point, Greg. And it's true in certain markets, especially right now, as we're coming off of this peak of the inflation, is you're starting to see certain carriers want to work with certain brokers who are specialists, and that's not just for HOAs, but other property risks.
So, Jonathan, let's get your perspective on all this and wrap it up. You're a board member. What perspective do you have as far as the experience, with insurance as a board member on an HOA, a big HOA?
Well, so, prior to 2023, insurance was just another expense like groundskeeping, utilities, tree trimming. And basically, when we set our budget, they just 5%, 6%, whatever. And the board just increased it and we went with that. But, after the Lahaina wildfires, when the insurance came in like 300% more, that was actually quite shocking for both the board and having to explain to the rest of the owners that this is what's happening. And, the other thing would be the budget trade-off. When you add such a large item to the budget, then you have to look at minimizing some of the other expenses where possible, of course. So projects and services, which is kind of difficult for the association to do.
It really drains your capital, doesn't it, when somebody increases your premiums from, up 300%.
Yes, exactly. I mean, for some of the boards, it's a little less painful because they built up, they actually can borrow from their reserves. But some of the others, you have to actually come up with the total amount through a special assessment, which a lot of people not expecting and haven't budgeted for it. People on fixed income, they don't have an extra 5, 6, 7 grand just lying around ready to hand over for insurance. So it did create a lot of stress, and I guess personally, like, a lot of backlash for the people on the board, because they think like, oh, why are you doing this to us? Well, it's not us doing it. That's the way it is.
Under the auspices of no good deed goes unpunished. So talk a little bit about the budget challenges you have too, because there's some knee jerk reactions in HOAs as well as like, well, we'll just start cutting this and cutting that, but that could lead to worse experience for the HOA members as well too. How do you balance that?
Yeah, so exactly. I mean, the first knee-jerk reaction was, "Hey, let's cut out all the big projects we plan. Painting, roofing, paving." But then you have to take a step back and say, well, if we don't do our roofing, wouldn't that mean we might have more leaks into units and more claims? So I think you have to look at, well, what is really for the preservation of the unit versus just plain aesthetics. Like, so maybe we don't plant flowers or things like that this year. We concentrate on really the physical attributes of the structure itself, right? Things that we actually need. I mean, we do our termite inspection, and we have our termite tree, all that kind of stuff, versus uh, stuff that is just, okay, it looks a little more pretty. Okay, maybe we can cut that.
So Ben, when you're doing the submissions, you're putting the insurance out to bid. What are he just said, maybe we don't redo the roof. What are the top three things that underwriters are asking about HOAs these days?
Yeah, so really what the underwriters are looking for, they're looking for the last time the roof was done, the plumbing, or HVAC, electrical, and yeah, so those are like the big ones that you're really looking
So
at.
you better know when those are done, and that's what they're looking at, because exactly what Jonathan's saying here is that's the knee jerk reaction to increase premiums, is to start to cut those things, and that's what the underwriters are looking for, is when the last time the roof was done. So yeah, Jonathan, tell us a little bit about your expectations, from a broker and from a manager. We've got both Hub here and CWD.
Well, what we're looking for from the broker is basically, help, well, basically educating us on uh, building replacement value, what we should be insured for. Because, I mean, as previously uh, talked about earlier, we don't want to be underinsured. That's for sure. And so that would be one thing. How things our replacement costs are valued, and also the various coverages we have and why we need them. And what they cover it for. Those would be the educational part of it, and then also to present us with options to see how we can get the best value for the homeowners association.
Okay. All right. Well, you're educating your board. That's good. Do you typically have somebody on the board that's an insurance expert, or are you all just having to come up to speed?
Normally we haven't had any, buddy from the insurance industry on our board. I mean, uh, I mean, once in a while there's like an owner that has, some experience, and we may recruit them to be like on, like a special committee to kind of study it. But normally, yeah, that's not, we haven't been fortunate enough to have anybody in the insurance industry on our boards.
Okay. Let's move on to the next slide here as we wrap this thing up. We're going to go back with some Q and A's. Question from the chat is what type of for anybody here, what are the most common D&O claims, directors and officers, and D&O claims can be very harsh. What kind of claims have you seen, Zach?
So typically what I've seen is claims when the board is making a decision that isn't provided or backed up by experts. So attorneys, insurance brokers, their management company. So usually if they're going against that advice, there's a D&O claim for that. Anybody can sue anybody these days. So being a board member is volunteerism, and it's a thankless job typically. But having that D&O coverage, as long as you're following the advice of your experts, typically your carriers are going to cover that for you and cover your defense.
Jonathan, this question's from somebody asking the question about, as a board member, what's the number one thing that keeps you with one eye open all night about insurance?
The thing that kind of I worry about a lot is basically it's like a death spiral to the association. It would start with the increased premiums, insurance premiums, which have to be passed on to the owners, and some of them can't really keep up. So then basically the association has to foreclose, and then things just get worse and worse. On the other side of it is that the association starts cutting maintenance, critical maintenance, and then again more claims, higher insurance premiums, and then it gets worse and worse with increased maintenance fees. So all leading to poor condition of the association's property, and in the end, lower resale value.
Lower resale value seems to be a big one there too. One of the questions that's come up here is, and this is for Ben or Greg or both, very quickly, why are there so few companies, insurance companies, wanting HOAs these days? What happened?
Yeah, it's a good question. I think that the hard market happened in short. We had, and it's not necessarily just condos and HOAs, just all property insurance got really stressed, largely driven by an increase in natural catastrophe disasters, which has made insurance carriers and reinsurance carriers take a harder look at their portfolio in general. And property 5 years ago was a loser on their balance sheets. But with the premiums going up and deductibles going up, as we talked about, I'm actually currently starting to see a little bit more capacity come into the market. So the answer is it ebbs and flows, and in the hard market years, some markets dropped out. But as premiums got to level off a little bit, we might see some increased capacity and more carriers come in. So it'll always be a dynamic market, but certainly we've been restricted for the last few years.
And HOAs tend to be in really nice places, along the water, along the beach, in the woods, in the hills.
Yep.
Jonathan, you're in Hawaii. Is that why they don't like HOAs?
That absolutely rings true. Yes, I mean a lot of HOAs, condos are natural catastrophe exposed.
So,
Wind zone.
Well, I mean, in Hawaii, you're either down by the water, which there are risks there, or you're up on the mountains, which again, scenery, everything like that. But again, that could be considered another risk factor.
all right, well, we're out of time. So if we did not get to your question today, and we didn't get to many of them, we will follow up with you. We will answer your questions back to you. So on behalf of Hub International, thanks for everybody. This was today designed for our HOA board members with insurance. It's been a tough few roads ahead the last few years with both coverage, deductibles, and premiums. We know that. We just want to make sure that we're giving you as much information, perspectives from property management, from HOA board members, and from our own brokers. On behalf of Hub International, thanks for watching today. Take care.